So a slate of retail earnings results are in, and some of the stuff that we looked at on Monday with respect to foot traffic seems to have panned out in the actual results, and the stocks have moved mostly lower as a result. We're going to talk a little bit about that and tariffs today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, the day before Thanksgiving, but it seems like a couple of retailers are not giving thanks. We talked at some length on Monday about Burlington stores and Kohl's stores going into their earnings results, both reported yesterday. And one of the things that we talked a lot about was alternative data. Alternative data can be an interesting way to get some insights ahead of a company actually officially reporting their results, because some of these sources track things in real time. So among the things that I mentioned, you have a number of companies that are actually able to track mobile phones as they move about. So they can actually see foot traffic going into and out. If you are dealing with credit card issuers like Visa or MasterCard, they don't sell too much of people's personal information, but they do sell a lot of generalized information to institutional buyers of all sorts. And so they can see whether the number of transactions are rising or falling, whether the amounts of those transactions are rising or falling. And of course, we already know what the demographics of some stores are. So for example, we were looking at Kohl's stores and we were looking at Burlington. Kohl's stores has a less affluent demographic. There has been a lot of evidence that the less affluent demographic is under considerable pressure. We see that in rising auto loan delinquencies. We see that in rising credit card balances and credit card delinquencies. And it suggests that certain demographics simply don't have the money to make discretionary purchases. So that means that we end up with a real dichotomy between those retailers that service the higher end and those that serve the middle-income consumer or the lower middle-income consumer. So as a little bit of a refresher, let's just start with Kohl's stores. Now, for those who were watching on Monday or who happened to read the article that I published over the weekend, you will know that I had suggested a strangle swap going into the print. Yesterday, I sent out a tweet, and my Twitter handle is @Michael_Co. I mention what that Twitter handle is because starting very soon, we're actually going to use a different X or Twitter handle for all things open interest related. So we also have the Twitter handle or X handle @OpenInterestPro. And just so that anything that's trade idea related, that's economy related, business and finance related to the content on this channel, if I'm going to put out posts that are related to that, that's where I intend to do it. And we will start spaces on that handle as well in the future that will be sort of simulcast with YouTube. So that will be a way to interact with us that's more tailored. And the reason for that is that my personal handle, anybody who follows me will know that, sometimes I'm posting things that are related to finance and investing, and other times I'm posting pictures of our dog. And that may not be of much interest to you. So for those who are interested in something more tailored, @OpenInterestPro is where you're going to be able to see that stuff in the future. So if you're looking at my screen right now, what we're looking at is some of that alt data. So we can go through observed sales and we can look at the transactions. And this is the same thing I was showing on Monday. What we saw was that the indications, at least from alternative data, suggested that there was going to be a pretty significant fall off year on year in these numbers. Now, by the way, these numbers are not exactly the same as the ones that I showed on Monday because, of course, we're now a couple more days in. And I believed the observed sales number on a trailing basis was showing down about 7.5%. I can go back and watch that other video to be sure, but I'm not sure that it matters that much. The observation I made was that when they reported their results, which we will show here, and I'm just going to switch this to quarterly. It's going to default to annual, so give me 1 second here. Switch this to quarterly. Here's what we're actually interested in. I'm going to blow this up a little bit, or maybe our production, our crack production staff can make this a little bit larger. Perfect. Okay, so this was the magic number that we were looking at here. So this is the sales. This is the top line, the revenue line. The alt data suggested this was going to be down about 7.5%. That probably helped account for the significant weakness that we saw in the stock. Remember, this thing was down about 40% year to date going into the print. You can see it fell quite a lot afterwards. It had a little bit of a pop going in, but obviously it's fallen significantly since. The number turned out to be even worse than the 7.5%, disappointed by another 100 basis points. But the strangle swap was still profitable. So for the total amount of money that was spent, which was about $2, or I think it was $1.90 or so, to put on the strangle swap the day prior to earnings, so on Monday, and that would have been the first trading day, actually, after I published that idea, that you would have been able to, because it was over the weekend that I put it on, and then, of course, on the Monday show. And you could sell that for about a 25% profit the day following. The other strategy that we talked about was a similar thing in Burlington Stores. And Burlington Stores, we can actually take a look at how that one has done since. That one was less successful. I think it dropped about 10%. So one was up about 25%. You put, whatever. If you put $1,000 premium into it, you'd make $250 in profit. On the Burlington Stores, if you had put $1,000 in premium into it on Monday, you'd be down $100, and it was worth about $900 after the results came out on Tuesday. So, do both of them, came out ahead. What I wanted to talk a little bit about today is that, I talk about these trades, but then I realized, and I've often talked about why we like them and what it is we're shooting for and the dynamic that we're trying to capture. But I wanted to be a little bit specific and take a look at these trades. And actually, of course, I haven't looked at them today, so it'll be interesting. I posted to take profits on the Kohl store one yesterday. I did propose that one could potentially roll the short side on the Burlington trade yesterday and keep the long strangle on. But let's just take a look at these two trades. And let's just, first things first, I'm going to display these trades in options play so we can just remind ourselves what these trades are. And then I'm going to pull the P&L for each leg of these trades up individually so we can sort of see how each option did. And why don't we start then with, we'll start with the Kohl stores one. And I'm getting a call, which I'm just going to send straight to voicemail. Okay, so here we are, Kohl stores. We had gone out to, and actually, I should have had this pre-queued up so I make sure I get the strikes right. I know we were going to be short, so we sold in the weeklies. In both cases, we sold the weeklies. And we had a call, and we had a put, and then we bought a call, we bought a put. These were longer dated. These were out to April. And let's see here. So we did this when the stock was 18. I think these were the 16 puts, or thereabouts. You can see it's blown well through that by now. And there we go. What? Oh, yeah, this was a diagonal. That's right. It had to have been. Because we didn't have, that's right. We didn't have, we had $2.50 strikes on the long side. So we couldn't do exacts. All right. So we go. And it was good to take profits on this thing yesterday by the looks. Oops, no, this is not correct. It's all right. This should be the 20s. There we are. Okay. So this thing was about $1.90. You can see that the stock was residing right about here in the middle, is around $18, maybe a little bit less. Would make more money to the upside if it ran to that $20 strike, make a little bit less to the downside. Yesterday when we talked about taking profits, this thing was 15, it was in the mid 15s, like 15.50-ish or thereabouts. So it was still in this profitable range. You might be asking yourself, okay, well, why did he want to take profits so quickly after that gap lower? Well, first of all, the move lower was larger than the implied move. It was larger than I anticipated. We expected that a lot of the bad news from that alt data was baked in. You'll remember that sometimes I refer to that 3-day rule, but sometimes you have a situation where you get bad news, as they got here, stock gaps lower, and then it can remain under pressure for a couple of days. Retail traders can respond very quickly and stop themselves out, which is effectively what we were doing. But institutional traders, it's a little bit more complicated. They have to digest the news, say, is this within our thesis or not, if they're on the long side? And even if they made an immediate decision that they wanted to bail out of a stock, it isn't necessarily that easy for them to do so. And the reason it's not easy for them to do so is because if you have a large position, a large concentrated position, it's just impossible to move big blocks of stock when liquidity starts to dry up, or even if it's decently liquid. To put things in perspective, and we can just take a quick peek here. Let's just take a look at what some of the larger holders happen to have. I mean, I'm going to exclude BlackRock, I think, from this calculation because BlackRock is mostly passive investing, so that's all ETF shares for the most part. That money, a lot of the passive dollars, they're not going to get juggled on news like this, because if you own the S&P 500, for example, they're constituents of it. SPY doesn't start selling stock on the basis of news. It does so on a rebalance of the index itself. So we can kind of ignore that. We cannot ignore something like 2 Sigma here. So 2 Sigma is a hedge fund. They can respond fairly quickly. American Century Mutual Fund probably won't be quite as quick about it. Citadel, for what it's worth, which is another big holder. Citadel, there's a lot of entities at Citadel, including some that are market making related. So bear in mind that when you see a Citadel or a Susquehanna or an outfit like that, those positions could be related to derivatives hedging, so it's probably less important to think about those. But the State Streets, the BlackRocks, the Vanguards, those are passive. That money's not going to move that much. T. Rowe, probably not going to move that much. Dimensional is a little bit of an interesting animal because they basically own the whole market. That's kind of their thesis. That was basically what they were based on. Actually, one of the founders who lived actually not far from here. The company's based in Austin, but one of the founders lived around here. He passed away recently, very recently. He was getting up there. But their academic thesis was that, in general, also more passive. But the 2 Sigmas of the world, Aero Street, Millennium, these hedge funds, they can respond fairly quickly, but fairly quickly is the operative word, because if you own 2, 3, 4 million shares, you are not going to go out and put in an order to sell 2, 3, 4 million shares at the market, or even with a limit. You are going to work that. You're going to give it to brokers who work stocks. You're going to ask them to solicit bids. You're going to try to find people that commit capital and just work out of it. You might put it into the algos and work it over time. And what that means is that when you have these downside gaps, the stock can remain under pressure for a couple more days. So usually I like to wait about 3 days to sort of get a sense of what's going on. And in this case, we had a downside move that was sharper than we expected, that was sharper than what the options market implied. And it was, on real new fundamental information, which was we knew that the numbers were going to be weak. The street was looking for about a 7.5% decline, an 8.5% top line, and that was enough. Pull the ripcord. We were up small in it. Great. Okay. Burlington, also as expected, their results weren't that bad. The foot traffic data that we had seen suggested that they were doing much better, and that they might actually grow year on year. And sure enough, that's exactly what we got, 10.5% year-on-year growth. So it does demonstrate the value of this alt data. It's very interesting to me how close these numbers were. And by the way, if you're wondering where analyst consensus is, when you hear them talking about, there's really a couple, a handful of sources where they're going to get information like this. One is obviously from the company's own guidance. We're guiding towards certain numbers. That's one place that the street can get these types of numbers. An alternative data is clearly another, and then they may also have some of their own independent channel checks that they can do to sort of get a sense of it. And by the way, if you're wondering, hey, how come Mike was showing all this alt data stuff when we were looking at Burlington and Kohl stores, and he doesn't show it for every single company that's reporting earnings? And the simple answer to that is that this kind of information isn't available for every company. You can't look at the foot traffic of phones for companies that don't have walk-in retail customers, for example. You can't take satellite photos of the parking lots at NVIDIA and think that that is somehow going to give you insight into how many Blackwells they sell. Just, it's different businesses, you have access to information that can be more helpful or insightful or give you cues. And, and then you just compare that to the price action. So here's what we got in Burlington. And in Burlington, we're just going to pull this up here. So, yeah, the other quick thing I want to show you before I move on to Burlington, because this was an important thing. So look here, and you can see what happened to the prices of the options involved. So you may remember that when we put this trade on initially, this short strangle, was about 55-cent bid, and we can see it's about $1.13 now. So that short side actually went against us as of today. Yesterday, not as much, because the stock was 75, 80 cents higher, and it's the put that is all of that, right? So this is expiring on Friday. That was the other reason, right, to ditch this thing, because that put was now in the money. Remember, we often say, whether you're long an option or short an option, once that thing gets more than 60 delta, it's going to behave a whole lot more like stock. And in this case, a lot of the decay that you could get out of it had already taken place. So there was little benefit in potentially waiting it out. You could adjust it. You could have taken the short side and say, I'm going to cover the short side and roll the shorts out a little bit further. But even if you had chosen to do that, which was reasonable, it still probably would have made some sense to contemplate adjusting the longer legs as well. And what you can see here is that, of course, the upside call option that we sold, worthless. Do you have to cover it? Well, you don't have to cover it. You can cover it for a penny or thereabouts. The thing's going to expire worthless. The stock's not going to recover back through 20 on Friday. But these other strikes, you also could consider just taking those down a bit and just rolling that structure down if you wanted to stay in it. So the 20... that's pretty far out of the money for a $14.5, $15 stock. So you might have actually taken that down to call it 17. So you take it to the 12.5, 17.5, and then you could have rolled the short side out, maybe to Dees regular way. You don't need the weeklies now, because the whole reason we were looking at those weeklies was just wanted to capture the decay. We knew what the event was. It was earnings. It was going to happen this week, and then it's all said and done by Friday. So if you're going to do something like that, then you would just roll these options out as well. And, the implied move over this period is going to be a little bit more modest. So you might do, looks like these spreads are pretty wide. And I can tell the spreads are wide because I'm looking at the mid-market prices. Notice that the 16.5 calls, you could probably hardly see this, but the 16.5 calls, the mid-market's 7. As it is for the 17.5s, and the 17s are 10. So it looks to me like that bid-ask spread on those is pretty wide, but you might do something like that if you wanted to carry it. But that's not what I proposed yesterday. I just said take the profits and run, because I think the stock's going to be on the move for a bit here. Okay. Yes, and Burlington Stores basically a very similar situation. We're going to put that one in now. But in this case, the stock did not move. Remember, when you put these trades on, the two best places for the stock to go are, one, to the short call strike, which is going to be the upside the way we usually structure these. So you take the implied move going into the event, it runs to that short call strike. That's the best circumstance. And the second best circumstance is if it runs to the downside put strike. In this case, the stock didn't really do much. And consequently, let's just take a quick peek at how this one went. So here too, if I remember correctly, we were looking at the Marches. What strikes do we have? I have to look at this. Maybe somebody who's in my ear will remember which ones we were looking at, but I think it was the 300s on the upside. Does that sound right? Was it the 300s? No, it had to have been... It's going to be in that neighborhood. 300s and the 260s. Bear with me 1 second. Probably should have made a note about this. And actually, I have it preloaded in options play as well. So let me see which one this is. We're looking at... That's Burlington. So Burlington was the... Wait for it. It was the 263.20. So the 260 puts was right, 320s. And now we need to put in a short call and put. And this was just the weeklies, of course. We need to see what the premium in these things. Now, of course, the premium on these things has essentially been eviscerated as well, as we would expect. But it was not... Well, this might have actually turned... What was the initial premium? Yeah, so... As of yesterday, that was down about 10%, suggested a roll. Oh, whoops, there's a problem right there. Okay, so this helps illustrate what's going on. Okay, so this would have been the best outcome. You run to the short upside strike. Second best outcome, you run to the downside put strike. Right here in the middle, a little bit tricky. Looks like we got into this trade 25.40. So at today's prices, 23.5, 25.4. So I had said down 10%. It's actually down about 7.5. So down 7.5% for each dollar invested. So, the long and short of it is, if you'd put both of these on, you came out a winner. Down, and we're going to just mark, we have to use the same day for both. So even though it's down 7.5% today, I'm going to look at yesterday, down 10%, because that's when I said close out the coal stores trade. So up 25, down 10. Yeah, it's all right. We probably not terrific for this kind of trade, but not bad either, right? Enough to buy a turkey or two, probably, on balance. If you put this on in like amounts of size, right? So one of them was about $2,500, so you would have to do a 10 lot in the coal stores trade to keep them about equal balance. And that's another important point I would like to make, which is that when we start stacking these options trades together, it's not like you take your whole bunch of capital and you throw it all at one or all at the other, or do them in one lots and one lots. The whole idea is, let's just say that let's start with a nice round number, $100,000 in capital. You could trade a one lot in Burlington. That's $2,500. It's 2.5% of your total capital base. You do 10 lots on the coal stores. That's also about $2,500 in round numbers, or about 2.5%. And that's probably a good amount to allocate. So you want to spread those chips around a lot. You want to. When we were at the hedge fund, we had a cap, a 5% cap at first. We later amended our LPs so that we could actually take positions up to 7.5%. In the 40 Act fund, we so 40 Act funds are much more heavily regulated. We had a 10% cap in terms of exposure unless it was a financial, because those are regulated separately. So we couldn't actually get into positions that were more than 5% generally of the fund into investment companies, banks, stuff like that. And then there was a little bit of wiggle room within the portfolio manager's discretion about whether something qualified as a financial or not. So, for example, I had a position in Berkshire Hathaway, and it cleared on our clearing and custodian side. I got an alert that somebody said, "Hey, you're violating the 5% holding in a financial," and I was like, "What financial?" And the number that they had was Berkshire, and I said, "Well, I kind of view that as a conglomerate. Granted, the bulk of their money comes from the insurance business, whatever." But yeah, so like that. There was something else that I thought was kind of interesting, and I just wanted to show this to you. So this is a trade flow chart, because people who've been following along know that President-elect Donald Trump has chosen a mix of figures for his administration coming in. Some of those are actually conventional, and a few a little bit more controversial to shape the administration. And, obviously amongst the more controversial ones, you could say RFK Jr. is controversial among some, because he has expressed considerable skepticism about the quantity and pace of vaccines administered to kids, for example. So some people call him an anti-vaxxer. I'll let other people decide to make their own determination about whether or not him pushing back on the pharmaceutical industry is a good thing or a bad thing. But where we are more interested, other than the ability of pharmaceutical companies to, for example, get government funding. So if you're looking at Moderna and Pfizer, obviously you're going to care a whole lot more than that. But for the most part, as you guys know, I'm not going to spend too much time thinking about those things. What was more interesting were things like Treasury and commerce. So Scott Bessent, who's a hedge fund manager, he's gotten appointed to Treasury. Kevin Hassett is a conservative economist, and he's going to be leading the White House National Economic Council. I think I previously mentioned that my former employer, Howard Lutnick, who's the CEO of Cantor Fitzgerald, where I used to work, has been appointed as Secretary of Commerce. And what is interesting about that, if you're looking at this chart, what this chart is showing are trade flows with our respective trading partners. So if you, let me see if I can highlight. All right, there we go. So let's see how clearly you can see this. So if you see an arrow going towards us, that means that we maintain a trade deficit with them. And if you see it going away, then we maintain a trade surplus with them. Needless to say, most are going to be flowing to us because we have massive, massive trade deficits. One of the reasons I wanted to point this out was because the first few hypothetical tariffs have been proposed. And those are 25% tariffs on Canada and Mexico. And why is that important? Well, if you look over here at this table on the right, you're going to quickly see why that is. We think of everything we sell in the United States as being made in China, and it certainly seems that way when you go to the store. But when it comes to our trading partners, Mexico and Canada are pretty important. In fact, this is why we had the North American Free Trade Agreement, or otherwise known as NAFTA. And I suspect that these things are going to be, I think these are a starting point. I think it's a little bit of a negotiating thing. I think some tariffs are going to be necessary essentially so that the Trump administration can chalk up a win based on the agenda items. It hasn't been said explicitly, or if it has been said, I missed it. But it occurred to me that if you impose a tariff on Mexican goods, and if they maintain a trade surplus with us from their perspective, a trade deficit with us from ours, which is the case, one could argue that at some point the incoming president would be able to say that some of that was paying for the wall kind of thing, right? Because you may remember before his first term, that was one of the promises he made. I'm going to build a wall. I'm going to get Mexico to pay for it. Well, impose some tariffs on goods and have a big trade imbalance. Indeed, you could offset some of that expense. Not saying that's what he's going to say. There is one thing I want to mention, though, and that is that Howard Lutnick, who I just mentioned on the commerce side, you can probably find this, and we probably should have grabbed it, and I would have had I thought of it. He was being interviewed recently about tariffs, and he explicitly stated that there was going to be wiggle room on these issues, that everything's a negotiation. And for what it's worth, for those that don't know much about Howard Lutnick, and I want to say, look, I worked for the guy. It's not like I spoke to him every day. I spoke to him very infrequently. There was the president of Cantor Fitzgerald resided between me and Howard, so my interaction with him was infrequent. I dealt much more often with the president of the company at the time, Phil Marber. But I want to say this about the guy, and that is that he's an aggressive entrepreneur, and he's been essentially running the whole show over there at Cantor and dipped his fingers into all kinds of business activities, from gaming in Las Vegas to crypto, real estate, a lot of things like that. So number one, his experience is very broad. Number two, he's an entrepreneur. Number three, I think that he's extremely aggressive. You can view that positively or negatively. I think in this context, this is absolutely a positive. If there's anything that I think is rather interesting about the dynamic when you have all of these guys in the room, is that most of the people that are being appointed to these roles, whether they're official cabinet positions or sort of de facto ones, like heading DOGE, the Department of Government Efficiency, like Elon Musk has done, is that all of these people, whether it's Donald Trump or Howard Lutnick or Scott Bessent or Elon Musk, all of these people have been the masters of their own domain. They haven't really had to answer much to anybody but themselves with their respective businesses. And I think it's going to be a very interesting dynamic whether those very strong personalities and those very strong sets of opinions are able to work effectively together. I'm cautiously optimistic. Scott Bessent is a very smart guy as well. And he's a much more conventional appointee. I think that we have seen in sort of the mainstream media, we've seen a lot of people talking about, the Matt Gaetzes of the world, his brief nomination for AG, which surprised a lot of people, including me, to be honest. So appointments like that are sort of the focus. But the truth is that when we really think about what's going to matter from an economic point of view at this point, and the AG question, obviously that was a very important appointment, but that's now over and done. Now we have Pam Bondi coming in. She's a loyalist, but she has served in that role at the state level before. I think it's going to be, I think I'm pretty positive about it. I think Lutnick, I think Bessent, people like this are what the country needs. So I'm generally optimistic about it. So I'm just going to offer that. But keep your eye on these, on this type of stuff. Just remember that when you hear these tariffs, 25% tariff on Mexico, 25% tariff on Canada. These are actually our two biggest trading partners. China comes in third. So just worth thinking about. One other thing to think about, we have a massive, massive trade current account imbalance. So our net exports, if you can see my screen, which you probably cannot, if you can blow that up. So that's probably very hard to see. But in this little white window that's there, our net exports to the world are just shy of $2 trillion, and our net imports are just in excess of $3 trillion. So net, little over $1 trillion trade imbalance with the world. And, we have talked about this being a problem for a very long time. We've managed to get away with it. It is largely financed by the fact that the U.S. dollar has enjoyed reserve currency status globally for global trade. That helps us sort of pull off that imbalance over lengthy periods of time. But if we start, doing things to, for example, Scott Bessent, if you guys don't know, he has this 3-3-3 plan. 3-3-3 plan was he wants to achieve at least 3% GDP growth. He wants to get the deficit down to 3% of GDP, and he wants to increase our domestic oil production by 3 million barrels a day. This last one, the 3% GDP growth, I would hope we can achieve that. That should always be our objective, better than 3% growth. Getting our deficit down, this is something we need to do. Increasing 3 million barrels a day. We're producing 22 million barrels a day now. That's the largest. We are the largest energy producer on Earth, outpacing second place Saudi Arabia by a pretty significant amount. And as oil prices drop, the government can facilitate permitting. It can expand areas for drilling. There's a couple things that they can do. They can, there's a lot of state taxes. California just jacked their gasoline taxes, so that can curb demand somewhat and encourage more efficient vehicle purchases, things like this. But at the end of the day, we are going to need to see prices justify the production, or there's not a huge amount to encourage a lot more activity. We'll have to keep an eye on that. But what I recommend is that there's a couple different rig counts. Keep your eye on the rig counts. But if oil prices continue to sort of languish, we'll just look at West Texas Intermediate because that's going to be the benchmark. It hasn't been strong lately, as we can see. That's ultimately what's going to drive this. So what could they do that would at least stabilize demand? They could try to refill, as I've previously discussed, the Strategic Petroleum Reserve, which is at its lowest level in... put this in here. Oh, I misspelled it. That's nice. Strategic. That's good spelling. There we are. So here we are. This is the Strategic Petroleum Reserve, lowest level in 40 years. I have to max this out, I think. So we're back. We're in this level. One thing they could do to stabilize prices, to encourage production, would be to try to replenish what the Biden administration sold to try to depress prices, which might be important from a strategic perspective as well. The downside to that is that it's an important component in inflation, and very few consumers are going to be happy if oil and gas prices rise. So my own thinking would be that they should be marginal buyers at this level and try to stabilize prices. And if the industry thinks, okay, there's a downside to 60. So I was on a panel last week. Commodity analyst at Bloomberg was on. He was saying that he thinks that WTI drops back down to $40 a barrel. Now, I don't agree with this. I actually made the point that 50 is the new 40 based on inflation. So, 40 seems a little out there to me. And I would hope that the administration would do something to stabilize prices enough that we sort of maintain production. One other quick point that I want to make. We have a very high percentage of domestic oil production in the United States comes from non-conventional plays, fracking, right? So why is that important? Well, you can shut in gas and you can essentially shut off the spigot for a conventional oil well. It is not so easy to do that for fracked wells. So you can permanently impair the productivity of a well if you suddenly shut it off. What's going on is they drill, they blow up, they crack the rock, they inject water, sand, and other things. And yes, people on the move. Let's get some questions answered. Are there? Oh yeah, what am I doing? I got to get to your questions. But yeah, I just wanted to make that point that the way we do oil and gas here it's not as easy to shut it in. So some measure of stability is going to be important. So FinWest, happy Thanksgiving, Mike, from across the miles and kilometers. Yes, happy Thanksgiving to you, sir, and I hope you, I think you were in Hawaii, but I don't know if you still are in Hawaii. But in any case, happy Thanksgiving to you and to everybody. So, and thank you for tuning in, right? This is basically the holidays, so it's big. Hello, Mike. GM is taking a hit from tariffs, scare, buying opportunity, or more volatility is on its way. I think I've said, yeah, so my thinking on GM, other than dealer inventories and things like that, is that I still think this company is cheap. And I don't think that they're getting an appropriate benefit for their ownership of Cruise. Cruise is probably the second best in the autonomous vehicle space in terms of technology, and their sort of three-mode approach, that using LiDAR, using radar, and using CMOS, compared to Tesla, which is basically just using CMOS sensors, and Waymo also has all three in use. I've seen these things in use. They have driven autonomously in this area, in the Bay Area, for extended periods before they suspended it after that accident, which was not their fault. And they're just not getting any credit for it at all. I mean, the thing's trading $55 a share. They're going to do $10 a share in EPS this year. They're going to do $12.2 billion in free cash flow, and that's on a $54 billion enterprise value. So we're looking at a free cash flow yield that is really, really good, right? This is, I mean, it's 20% free cash flow yield. If the numbers for next year are realistic, which is obviously a significant discount, and this is the reason it's trading cheap, is that I think people think that cars have gotten very expensive. There's buildup of inventory on lots. Higher rates have made the payments get higher. We've seen rising auto loan delinquency. There's a lot of reasons to be concerned about the auto business. But a lot of that bad news is also priced in, and they have no benefit whatsoever for their autonomous vehicle technology in the form of Cruise. So I see headwinds in terms of the car business. Those are legitimate. It's not a growing company. You guys know that I usually favor companies that are growing. But I see that the value in that AV is kind of making up for that. So personally, I still like it. And I'd probably trade this one on the long side before I would buy Tesla, if AV is what I'm thinking about. I bought so spicy barbecue. I bought the dip on Target yesterday. Yeah, this is interesting. So we've had these kinds of situations before. This one is, again, getting so cheap relative to some of their competitors. They continue to stumble, but they are in general, the good news is Target has a model for success. And I'm not talking about saying, okay, they could be Amazon or anything like that, but they can follow the model that Walmart has done. And they have done. They've brought more groceries in and things like that. And, so I still think that that's a decent business. And let's just take a look at that one in terms of valuation too, because it is indeed a lot cheaper than some of their competitors. So again, kind of a moribund top line, but let's just say for the sake of argument that next year, and again, this says 2026, but that's for the fiscal year ended January 26, which is really calendar year 2025, $9.30 a share. So, versus the current price, that's less than 14 times forward. And in terms of the historical turn to forward earnings, that's got to be towards the lower end of the range. So we're just going to take rid of this. So this is where we are. So historical valuations. You can see we're right down in here. So is it as cheap as the thing has ever gotten? Well, it got cheaper at the tail end of 2018. You'll remember there's a big swoon in the market. And that's also, part of the context, right? So can it get any cheaper? It could. What are we looking at here? 2 turns. So 2 turns, another $18. Call it 2.5 maybe. So we'll call it 20. Maybe that's your downside relative to a $130 purchase price, assuming they don't have any more nasty shoes to drop. But yeah, I kind of like it. for this reason. The bad news, I think, is sort of baked into the cake, and hopefully they'll be sensible. News just came out that the FTC is going after Microsoft for antitrust. This is the second time they've gone after Microsoft. And, we talked a little bit about what they were doing with Alphabet and spinning off Chrome and all that kind of nonsense. So here's the interesting thing. Lena Khan and the gang over at FTC, they're out ski, right? So we're going to have an incoming administration's appointees to these departments. Admittedly, Trump has, he's a business guy, but he's not a huge fan of the tech giants. I'm kind of with you on selling the upside there. I might even sell upside and downside more than just betting to the downside in Microsoft, because this is going to drag out for a while. But I think you can sell a little bit of upside in it. This is also valuation based, because it is trading. We can see right here. Is this death cross? Let me see. Take a quick look. It's awfully close. Look at that. Let me get rid of the 100-day so we can see this a little bit more clearly. I mean, we are right in there. I think it may have actually officially crossed in today. So I don't mind selling upside call spreads, but I also don't mind selling upside call spreads just because I think the valuation, it's been in a pretty lofty region. This thing got massively cheap several years ago. It long since made up for that, as we can see here. So we're looking at a 10-year turn to forward right here. And again, not all-time highs in terms of the multiple, but it's above average. So the average is 26.76 times earnings, and we're trading at 31 times. This is forward, by the way, that I'm talking about. So yeah, I like that, selling upside call spreads. And that death cross, I probably need to see over the next couple trading days if it's definitive, because you can see it's right there. But we don't like death crosses either. Monday Morning Quarterback says, Super Micro, if it's delisted, does that affect the options? Yeah, it does. Unfortunately, yes. It doesn't mean they just go away, but you're not going to be able to trade them. And there's another problem, which is, let's say this happened in some of the banks. So was it Silicon Valley Bank? This was a really bad situation. People bought puts, bet against it, stock stopped trading. They had in-the-money puts, and their clearing firm would not permit them to exercise the puts because they didn't have a formal borrow on the shares. And since they had stopped trading, it became very questionable. So this is a pretty tricky situation. And yeah, I would encourage you. And this is a funny thing. So if you were, if you're going to do something, and you need to be able to exercise into or out of the stock. If the stock stops trading, your broker can actually prevent you from exercising your option. And that's just a cautionary tale. I had people reach out to me and specifically say, this is what happened. They made bearish bets, so they won. They bought puts and bet against the company, and the company essentially went out of business, and they couldn't do anything. So they ended up losing the premium they spent, even though those puts were massively in the money. So if you think, for this company, whether it's Supermicro or any business, if you think that there's a risk that the thing's going to stop trading, you may not want to have that trade on. Now, interestingly, imagine you had sold a deep in-the-money call spread, right, which is synthetically the equivalent of being in a put spread. You would have collected the money up front. Now the thing goes down. Well, no one's going to exercise the short call against you, and you're not going to exercise your long. So it's in a very weird way. That actually would have ended up being a better trade because you would have collected all the premium. So let's just say, you sold it for, if the put spread would have been 20% of the distance between the strikes, then that same synthetic call spread would have been 80%. So you would have collected 80% of the difference between the strikes, and then the whole thing stops trading and you win. So bear that in mind. Sometimes you get these sort of wrinkles, and just consider those potential outcomes, and you'll end up doing some trades that, because usually, as you guys know, I don't favor selling deep in the money credit spreads. That doesn't normally make much sense, but it could in a case like that. So that's a little bit different. What's the minimum cash margin one would need to start a market make? You're saying market maker? And do you need expensive market maker software to automate? I'm assuming, Spicy Barbecue, that you were talking about. So market making is a pretty sophisticated business now. We built our own models. So we built a trading system that we called Optum, OPTOM, and we employed something that we called our VSK model, which was, it was a model where we could just input a handful of factors really quickly and sort of get to where we wanted to go. V was for volatility, S was for skewness, K was for kurtosis. So those were the principal moments that we would put in for the distribution for any given expiration. Then we had obviously the carry cost issues, the dividends, and then something related to each. Then we had like an anchor volatility for each expiration. But you need quote engines. The amount of capital is going to be significant. You need a clearing arrangement. If this is your question, and I'm not 100% because, market making isn't something you just sort of pop into. I mean, you're going to be competing against Susk, Citadel, my old trading firm, Bluefin, and several others. These are sophisticated trading operations with a lot of capital, a lot of expertise, and a lot of technology. DRW. So, something to think about. If you have an options position, you can still exercise or be exercised against you, but you might have big problems trying to sell the options themselves. Yeah, if the market's not open, you can't transact in the options. Just leave it at that. And you may or may not be able to exercise your options depending on whether your clearing firm believes you can do that. Eileen, enlightening chart on trade. All the data you post is interesting. Happy Thanksgiving. Oh, well, thank you very much. Appreciate that. IoT. This is did I share that? You're interested in IoT. We'll take a quick peek. Whoops, what did I just do? Typo. Okay. Yes, that does appear to be in a solid uptrend. A little bit weaker today. Let's take a look at the technicals. Just not my technicals. Let's just screen all of them and see what's going on. So it looks like principally bullish, and it looks like, if anything, a little bit overextended is, because Bollinger Bands, commodity channels, RSIs, stochastics, these tend to be measuring whether something is overbought or oversold in the near term. And, we can see that RSI got a little bit high. Yeah, right in there, but it's probably at this point pretty much right in the middle. How does the street feel about this thing? Generally pretty positive. No recent rating changes. How do we feel about its valuation? Well, let's just look to next year. So 26 cents. I mean, that's pretty chunky. So we're looking at 20 times price to sales. And that's a pretty rich multiple, but it's got a good growth rate. Yeah, price to growth. I don't know this company super well, admittedly. Looks a little pricey to me, but okay. And in terms of volatility, let's see whether options are reasonably priced. So this is, oh, actually, you know what? Better double check what the catalysts are coming up for it. So we have, oh, they report next week. They're reporting earnings on the 5th. 10% implied move. Wow. Wow, does this thing move on earnings? Holy smokes. This thing has moved double digits the day after they've reported. Every single quarter going back to mid-2022. Okay. So, let's take a look at what options play has for us. Let that pull up. Mike, what do you think on STLA? Okay, I'm going to get to that one in a second. Here we are. So let's take a look at a vertical in here. 9.5% implied move. Although that's big, it's not that big for this name given how much it has moved historically. Probably going to want to watch your limits pretty carefully. But, you know, a trade like that, if you're looking to lean into it on the long side, you know, isn't going to risk. I mean, you're going to take a 6% risk essentially on the current stock price, and this is on something that has moved, you know, 12 to 18% on average over the course of the last 8 reported quarters. So if you're inclined to make a bullish bet, something like that, maybe even in the money call spread, I don't normally recommend those, but something like that would probably work as well. Again, just a couple quick things. I don't follow this company. It's pretty pricey in terms of its valuation. Good growth, at least as the street appears to be looking at it, but yeah. Okay. Mike, first of all, you have a beautiful family and you must be very proud. Well, thank you very much for that. What picture of the family, I'm wondering, are you seeing? Do I have one posted somewhere? I don't know. If it's our old pictures, there was a picture on one of somewhere floating around, but that was, you know, probably 10 years ago. The kids were little. Both my kids are in high school nowadays. So I have a freshman and a junior. So I'm not sure how recent the pictures are that you've seen of the family. We have a good-looking dog. Our Great Pyrenees, Sophie. Okay, so I know you get asked this a lot, but where is MicroStrategy heading, and what is your Bitcoin target for 2025? Happy Thanksgiving. Higher for Bitcoin and MicroStrategy. So I want to say this is a couple things I would have to say about MicroStrategy, because number one, I think it's a fascinating business. First of all, why in God's name is nobody competing with Michael Saylor on this? It makes no sense. I mean, he figured it out, right? There's a huge class of institutional investors, namely fixed income guys, who would love to have a little piece of Bitcoin because it has a phenomenal impact on a fixed income portfolio, and they can't buy it. They can't buy the futures. They can't buy options on the futures. They cannot buy the ETFs. They cannot buy options on the ETFs. They cannot buy Bitcoin, and they can't mine for it. They can buy fixed income instruments. So have a company that buys Bitcoin. Issue convertible bonds. This is what Michael Saylor has done. Of course. Why is everybody else who has a publicly traded company and access to the capital markets who could issue some zeros not doing that? And it's a win for the high yield investor. I think I illustrated this before. I'm going to do it one more time. So HYLB is, HYLB. This is a high yield ETF. Competes with HYG. Let's just take a look at its performance year to date. Okay, so this thing is up 8.74%. That's up about 70 basis points, I think, versus what we were looking at before. Okay, now let's throw MicroStrategy. Oh, I have to find these. I'm going to find the MicroStrategy zeros. For those of you who've seen me do this before, I apologize. You're watching me do it again, but I think this is important. So the bonds I want were what was it, a 2027 zero? Yeah, here are the 2027 zeros. When were these issued? So MSTR 002 1527 corporates. MSTR 0 2 1527 corporates. Here we go. Voila. Why isn't it putting the results? There we go. Okay. So I want you guys to think about this for just a second. You run a high yield bond fund. You're trailing the index. The index is up 875 on the year. You're up 8. If you had allocated 1% of your fund to the MicroStrategy Feb 27 zero coupon converts, that would be up 210 basis points. That would be a 210 basis point boost to your performance. Okay, so instead of being an 8% performer and trailing your benchmark by 74 basis points, you've now done 10.1% on the year, and you are outperforming your benchmark by more than 125 basis points. This takes you from the also-rans into the best in your space, right? That's how big a difference 200 basis points to a fixed income manager can be. So this is, it's a huge benefit. So there's a huge amount of demand for something like this. And what's the worst thing that can happen? Even if it traded down to tangible book, right? So what this means is that there's a lot of demand for what he's offering. I just don't understand why others aren't doing it, because it's pretty obvious why someone would. MicroStrategy is going to generally trade with Bitcoin, but it has a lot of leverage, and I'm not sure that the OpEx, the operating business, right? And what is the operating business? It's not his computer services business. The operating business is the accretive effects of issuance. So every single time he issues a convert, for example, and there's a spread, between, say, the strike on the convert, he can actually go out and buy Bitcoin, and the difference between that is accretive to the shareholders of the, to the equity holders, right? So he refers to that as, the Bitcoin yield. Now, there is another form of Bitcoin yield they can get, because you can also lend. So, whether he's going to get into that business is another question. So there's things he can do in the space which can be beneficial to the shareholders. But that gap between the tangible book value, the value of the Bitcoin that MicroStrategy holds on its balance sheet, and the value of the company right now is a very big one, right? So I'm trying to remember what their holdings are, but it's worth about 35 billion. I'm not sure how much he's bought, because he was buying some over the weekend, I'm sure. But you have a $90 billion company. Let's call it round numbers. Let's give him the benefit of the doubt. 35 billion in Bitcoin, $90 billion company. Okay. Well, where does that get us? That means that there's $55 billion associated to the operating portion of the business. Why not just buy IBIT? Buy IBIT and be done. I think if you want to trade something that's equity-like, why not? That's my 2 cents. And you can trade options around it, and it's a little bit less volatile. If you want leverage, you can create leverage on IBIT yourself. So if you want leverage, use leverage. But I'd probably be inclined to trade IBIT. But this is also because I think other people are going to look at what Saylor's doing and saying, well, why don't we do that? And if they do, then presumably that very comfortable margin that he has, is going to narrow, because people will have alternatives. Right now, he's kind of the only game in town to do it. Okay. Jose Favila, yeah. Hi, Mike. Happy Thanksgiving. Really like the capabilities of the Bloomberg terminal you are using. Any idea of the cost to subscribe? Yes, I have a very good idea of the cost to subscribe, because I pay it. It's about, depending on how much data you get, figure 35 to 50,000 a year. That's what you're gonna be paying. $35, $3,000 a month is kind of the entry level for a Bloomberg terminal. So it's chunky for most self-directed investors. I've had a Bloomberg terminal. It's scary to think about it, but I've had a Bloomberg terminal for 20 years. So do the arithmetic, and you begin to realize they've taken a lot of my money over the years. A lot. Like, I don't know, 2 times the price of the average American house. Something like that. In fact, actually, is it worth it? Obviously, I think it's worth it. But my understanding is that Alphabet is trying to come up with some things to compete with the terminal. So we'll see what happens. Look, we'll probably come up. One of the things is that, and I'm only barely scratching the surface of what the terminal does. There's a lot of APIs. My spreadsheets are all fed through the data here, and I'm barely touching what this thing does on these things. So when you guys have questions, you want something obscure, I can get all kinds of stuff out of this. Maybe watching this live stream or subscribing to one of our other services is the best way to get it. At some point I'll probably offer a service where people can, drop their portfolios and we can do a deep dive analysis in this thing, and it can, we can go back and do past scenario analysis, dive into each and every one of the investments. There's a lot of stuff you can do with it. It's pretty sophisticated VAR analysis, stuff like that. Okay. So Michael Anthony, you're asking about Stellantis. Yeah, so here's the thing about Stellantis. What Stellantis has been doing, their business thinking, ask a Jeep Ram dealer how they feel about Stellantis right now. Probably not that happy. They decided that they were going to take the Jeep brand in particular way up market. So Jeep Wranglers 30 years ago were a pretty entry-level vehicle. And they became a luxury vehicle. And that's fine if you happen to live, close to where, if you live in Marin County, California, Northern California, where I live, $65,000 cars are pretty common. But for much of America, that's not so true. And that's a problem for them. They're starting to see building inventories. That's a problem. And I think the dealers are quite unhappy about it. And they had some, production delays, and so that created pent-up demand. But there was a high-end buyer that was not that discriminating about price, but the bulk of their customers were not the type to go out and buy things like their Grand Wagoneer. So the Grand Wagoneer, for those that don't know, but that's their top-of-the-line product, those things could run $100,000 now. And, people... That was Escalade territory, Range Rover territory for a lot of people not that long ago. And I think it's going to come back to bite them. Like I said, we have rising inventories. We're seeing bigger discounts. That's a problem. So Tucker D. Dog says, Stellantis moved Jeep to luxury vehicle in price only. Yeah, I guess that's somewhat true. In fairness, you didn't have Wranglers with leather seats and all that other kind of stuff back in 1990. It was a really basic vehicle. But the fact is that I think they're going to find themselves in trouble. So, Mike, zero coupon doesn't mean MicroStrategy offers no interest. Yeah, that's right, no interest. The zeros they're paying no interest. So they are issuing debt with no interest on it. And if you're wondering how or why they are able to do that, who wants to loan the money and not charge them interest to do it? It's because it's convertible into the equity. So it's a form of an option. It's a bond that is also has an embedded call option on the equity. And that's why people are buying it. They are not buying it for the interest. They are buying it for the equity component. And so converts are what we call a hybrid security. They're partially a fixed income instrument, and because of that embedded option, you could think of them partially as an equity instrument or just as an option, which is probably the best way to think about it. That's the way that most people that I know in the space think about them. as a bond with an option component. But that's what that is. So does this mean that Goldman will issue CDS on MicroStrategy debt? 2008 all over again. Yeah, I imagine that you could get some. There probably is some CDS trading on it already, but I'll bet you it's not a good market. Let's see what they. Let's see if we have some CDS in this. Oops. Probably do have equity futures, stocks. One quick point I want to make about this, and that is that those converts are now deep in the money. So they trade a lot more. They trade a lot more like a deep call option than than anything else. Okay, so Michael Anthony, yes, Stellantis PE is so low. Yeah, true enough. This is typically what you'll see. And actually, this is kind of the number that I'm even more interested in when you're talking about an auto company, which is the enterprise value. So the enterprise value, and they're basically their cash and their debt. They actually have net cash, so you can see the current market cap's about $36.5 billion, but the enterprise value. So if you take the cash out, so that's the value of the business x cash x debt, is less than $25 billion. So that makes it pretty cheap, and $160 billion in revenues. Let's just put GM in here for oops, a fat figure for okay. So let me get this in here. Okay, I realize I'm running a little bit long and all of that, so I'm going to try to be quick and get this in. But so it's in the same scale as General Motors, but their top line is declining much faster. Look at this, 16% year-on-year declines is what's anticipated, with negative free cash flow. Other things that are going to be of some interest, this is how many cars they're selling. So, full year through the end of 2023, they did 6 million cars, which I think is less than General Motors, but probably in the line of Ford. So General Motors did, what did they do? Oh, it's about the same. 6.2. Okay, so they're selling about the same number of cars, but it is a problem. So they've got issues because their sales are falling a lot faster. Another company where we're seeing sales falling is JLR. It's an Indian-owned company now, but there's been a lot of controversy about their most recent advertising campaign, which didn't show a car and just showed a bunch of people running around in, looked like a fashion show from some dystopian movie. But yeah, I mean, I think it's, if you want to speculate on the long side, I guess that's okay, but I want to just describe that this is a company that's in significant distress. 16% top line revenue declines. It's pretty big. It's a pretty big decline. Yeah, I mean, how do we think Ram trucks are going to do relative to Ford and GM? They haven't updated the heavy duty versions that much. Yeah, they got a couple issues going on there. But yeah, it is very cheap. So actually, what's the vol? That might be another thing to do, is just consider they need a new CEO who's got to sort of get religion on repositioning this. Some of these brands have to be brought back to more middle market, in my view. Okay. Infinity initial marketing got skewered for paying a lot of money to show ads that didn't people what the product was. Yeah. Okay, so it's late in the day. You guys are all doing your last-minute shopping and getting ready for Thanksgiving. I really appreciate that you guys were even willing to tune in because, frankly, going into the holidays, I'm sure you have a lot of other valuable things to do, like spending time with your family and eating and drinking well, which I hope you all do, and I hope you all have a great Thanksgiving, and I hope that you tune in when we do this again next week, Monday, 4:15. Happy Thanksgiving, everybody, and thank you very much for watching.